Welcome back to FX Street. It's 8 a.m. Eastern. Welcome back, one and all. Great you could join us. In 30 minutes from now, 8:30 a.m. Eastern, U.S. GDP numbers will be released. This is a big number. Better than expected? Well, then the market may expect the Federal Reserve may do one thing. If they're below the expectations, they may do another. What they're going to do, well, that's left to a little bit of interpretation, but we can make an educated guess what that may be. But for 2012, the GDP, gross domestic product projections by the Federal Reserve, are 2.4 to 2.9%. The January projection, which was the previous meeting, was 2.2 to 2.7%. So they've increased the projections a little bit. And you can see at the unemployment rate, in January they had forecasted, the Federal Reserve had forecasted that for this year the unemployment rate would be 8.2 to 8.5%. Their estimate now is a little bit more optimistic. They said 7.8 to 8%. And then we look at the PCE inflation figures, which is essentially the level of inflation, estimated 1.9 to 2%. And core inflation, which does not include food and energy, is 1.8 to 2.0%. So, as far as what we're looking for today, we're looking for a GDP number of anywhere from 2.4 to 2.9%. The FXG economic calendar estimates that GDP will be around 2.5%. This is the economic calendar. And by the way, the previous report was 3.0. Now, if the number is better than expected, what does that mean? Well, over the past couple of years, Federal Reserve has a very limited, well, they always have a very limited arsenal of what they can actually do. They cut interest rates down to zero. That was not enough. They said, okay, we're going to give the economy stimulus, quantitative easing 1, quantitative easing 2, Operation Twist. And as bad as the numbers got, obviously the Federal Reserve can't cut interest rates below zero. Well, in a sense, they actually can, which they have, and I'll tell you about that in a second. But what they did is they enacted quantitative easing 1 and quantitative easing 2 that had intended and unintended consequences that we talked about a lot here. The intended consequences is that they buy the long-term treasury bonds and it keeps long-term yields low. That's one of the reasons why mortgage rates are so low and interest rates are so low across the board. And the unintended consequences is a weakening dollar, which in turn has sent up commodity prices, which has not been that good. Gasoline prices are at all-time highs, and other commodity prices are very, very high as well. So, Federal Reserve fell under a lot of criticism. They said, well, we can't give you any more quantitative easing. We'll do something else called Operation Twist, where they still buy long-term treasury bonds, but instead of printing money to do so, they sell their equivalent amount of short-term treasury bonds. Now, that has its own intended and unintended consequences, like shrinking the bank's profit margin because the yield curve, the difference in interest rates between long-term and short-term maturing treasuries, that has shrunken, that has compressed to a great degree, and that hasn't been good for the profit margin of banks. That's, another discussion. But what we spoke about, I actually have a chart, and if this is a little bit of a repeat for some of you, I apologize, but it's really kind of important. Okay? This is the question on everyone's mind. This chart happens to come from agorafinancial.com, but there are many, many different websites that have this chart. The first shaded area represents the time that quantitative easing was announced. Quantitative easing 1 was announced until the last day, when the Fed was printing money in order to buy long-term bonds. The blue line represents the S&P 500 equity index. In other words, when we have quantitative easing, stocks go up. When quantitative easing ends, stocks go down. QE2 started. The first day it was announced, stocks went up. As soon as QE2 was over, stocks went down. Then Operation Twist was announced. Stocks started to go back up, and Operation Twist is scheduled to end this June, in another month or so. This is the question on everyone's mind. If today's GDP number is worse than expected, 2.4 to 2.9% range, I hope you can see the chart okay. I'll refresh it here. If GDP is worse than expected, below 2.4%, well, we know the Fed can't cut interest rates below zero, but will we get another round of stimulus? We had QE1, QE2, now Operation Twist. Operation Twist ends in June, and the GDP numbers coming into June are not so good. Well, that could certainly lead stocks down. And, I wouldn't be so naive to think that there are not political ramifications, especially in an election year, where, obviously political parties want to see the stock markets as strong as possible and the economy as strong as possible coming into an election, and not only presidential elections, but also congressional, but that's, a different story. But the point being is, if history has been any judge, that when stimulus ends, markets go down. Stock market goes down. Those higher yielding carry trades like the Aussie yen and the Kiwi yen, they also tend to go down. On the other hand, stimulus also has tended to weaken the dollar, because when we print more dollars to buy more bonds in QE1, QE2, that has weakened the dollar. So my theory is that in June, when Operation Twist ends, and let's say Operation Twist ends and we get a really bad GDP number today, I think that means that we're going to get more stimulus, or at least the market will believe that we're going to get more stimulus. And in turn, that could actually be a positive for stocks, because remember, the market's a forward-looking mechanism. It's always trying to guess the next step. And the next step is, well, if the number is bad today, and looking forward 30 days, June, that, a little bit more than 30 days, Operation Twist is going to end. Well, does that mean we're going to get more stimulus? And stimulus, generally speaking, has been good for the stock market. I'm trying to guess the immediate reaction. What's going to happen today at 8:30 a.m. Eastern, 10 o'clock a.m. Eastern. I'm trying to find the trade today based on, what the picture is. So I think that if the number is bad today, that means number one, interest rates are going to stay low as long as possible. And the Fed yesterday said at least through the end of 2014. Number two, it means that there's a greater possibility of more stimulus, which I think could be good for the Aussie yen and the Kiwi yen, because I think it could also be good for the U.S. stock markets, the NASDAQ, the Dow, S&P 500, and I think it could be a negative to the U.S. dollar. So I think that the Aussie yen could go up, the Kiwi yen could go up, because they would follow the stock market up, carry trade, a risk-on, optimistic type of day. Despite, and I know it's illogical, that why would a bad GDP number send the stock market up? But a bad GDP number means we get more stimulus. And one of the reasons why the stock market's been so strong over the past couple of years has been bad stimulus. One of the reasons why the stock market's been so strong is because of stimulus to try to fix a bad economy. Conversely, if the number is much better than expected, 2.4 to 2.9% range is what is expected. Let's say we come out 3.5%. Beats last quarter, beats all estimates, shows a real improvement. That means, number one, no more stimulus. Number two, stimulus is over in June, so we only have one more month of stimulus, and that's it. And number three, well, the Federal Reserve may not wait until the end of 2014 to raise interest rates, and we want to raise interest rates when there's evidence the economy is improving, but ultimately interest rates actually slow down, higher interest rates slow down the economy. So I think if the number's better than expected, I think stocks go down. I think that the Aussie yen and the Kiwi yen could go down, but the dollar, I think, could go up, because the dollar is always trying to guess what is the chance the Fed is going to raise interest rates. Last Wednesday, when the Fed met, before the Fed met, there was the Fed funds futures, which is a futures market that tries to guess when the Federal Reserve will raise rates. The chances, I remember these figures, the probability that the Federal Reserve would raise rates by the end of 2014 was at 66%, and now, after the Fed meeting on Wednesday, went up to 74%, 77 to 74, I think it was 74%. Because their statement alluded to the fact they're a little bit closer to raising rates because things look a little bit better. Or it's because Ben Bernanke said in a statement, you know what, we have more tools in our arsenal. Now, if Operation Twist ends, we start to tweak the Operation Twist. That's also a possibility. So we may not get quantitative easing because that has not been very popular because of its impact to oil and commodity prices. Quantitative easing, Operation Twist, well, I think that's been somewhat popular. Operation Twist, again, is you have long-term U.S. Treasury bonds with maturities of anywhere from, I believe it's 60 years to 30 years. The Federal Reserve has committed to buy those bonds. I think it's $400 billion worth of those bonds. And they're going to sell an equal amount of short-term securities. I think the maturities are anywhere from 1 year to 5 years. And what that does is when you buy the long-term bonds, the bond price goes up, the bond yield goes down. So long-term bond yields go down, but they're selling the short-term bonds. So you sell a short-term bond, the bond price goes down, the yield goes up. In other words, long-term bond yields like the 30-year go down, short-term bond yields at the 5-year go up. The difference between the two, that's the yield curve, and that shrinks. And if you think about it from the bank's point of view, you know, it really does, it does mean a lot. That's why I mention it quite often. If we're running a bank and a customer walks in, deposits money in their savings account, we're going to pay that customer an savings rate, which is the equivalent of a short-term bond, let's say a 2-year bond. And if another customer walks in and applies for a loan to get a mortgage for a house, those loans are based on 30-year long-term treasury rates. Now, if Operation Twist sends long-term yields lower and short-term yields up, in other words, what it does is it makes those mortgage rates cheaper, less expensive, but the bank's making less money, and the bank is in turn forced to pay higher interest rates on savings. What does that do to the bank's profit margin? It shrinks it. They have to pay more in savings accounts, and they collect less in mortgages. The bank makes lots of money. So ultimately, that's not good, and it's not just the banks. I mean, we're talking, you know, the financial market touches every point of this economy. It's not just the banks and the credit card companies. Think of insurance companies. Think of GMAC, the financial arm of General Motors. At one point, I believe I heard that GM made more money from the financing unit than they actually did from making cars, if that's possible. And I don't know if that's right. That's something I remember hearing a long time ago. But interest rates touch every part of this economy. So it's certainly not a massive stimulant to the economy from the bond market's point of view. What it does is incentivize customers to get out there, consumers to get out there and to buy a house, to buy a car, to buy big ticket items, to stimulate the economy immediately, to get the customer back out there. But long term, I don't know necessarily if it's healthy for the economy. Stimulology are the ways to stimulate the economy. Ben and Geithner will do just that. That's, you know, I mean, we have the GDP number coming up very, very soon at 8:30, so I don't want to get too far off tangent, but too far off topic. But you know, when we look at economics, the Federal Reserve is based basically on the premise of Keynesian, John Maynard Keynes' Keynesian economics, which basically says, let the market do what the market's going to do, and let the economy do what the economy's going to do. But we're going to soften the terms, meaning that when the economy is very, very strong, prices go up a lot, commodity prices go up a lot, and this could really start to hurt a lot of people. If gasoline is all of a sudden $5, $6 a gallon. So let's slow down the economy just a little bit when the economy is very, very strong, such as raising interest rates. Make it a little bit more expensive for investors or for consumers to go out there and to buy a house. They'll slow consumption down. Higher interest rates raise yields in the bond market, which attracts capital into the bond market and out of the stock market, slows down investment, slows down a very, very strong economy to prevent a bubble. Now, conversely, when the economy gets very, very weak, the Federal Reserve lowers interest rates to stimulate spending, to stimulate investment. That it's supposed to attract capital out of the bond market and out of savings accounts and back into the stock market. Makes the stock market look more attractive. That's Keynesian economics. But that's about all they're allowed to do. The Federal Reserve has a dual mandate from Congress. They're told by Congress you have two elements, two jobs to do, but this is it. You're supposed to control prices, meaning inflation. Don't let inflation get too high. Don't let inflation get too low. That's number one. Number two, create an environment that's conducive for jobs. Create an environment where jobs will be created. Jobs and prices, that's it. And usually the Federal Reserve has a very limited scope in what they can do. Now, I was not this much of a central bank watcher, 10 years ago. But I don't ever remember, under Alan Greenspan's watch, hearing about quantitative easing and Operation Twist. Operation Twist was tried in the past in the 1960s, but I don't remember it in the 90s or in the previous decade as the Federal Reserve being so active. The question is, could the election be, could an election be an election ploy? I think that the elections play a very big role, and I think the Federal Reserve, which is supposed to be a completely independent body, they're not supposed to be an extension of Congress or an extension of the executive branch, meaning the president. It's supposed to be completely independent. The Federal Reserve is not part of the three branches of government, the executive, legislative, judicial. It's a completely separate entity. But it seems that the Fed is a lot closer to politics than I remember them ever being before. After all, quantitative easing, I think, was a direct result of, a lot of people putting pressure on the congressmen, saying, listen, our economy's in a lot of trouble. You got to help us out. And by the way, we have elections coming up, so you better help us out or else. So Congress tells Ben Bernanke, listen, do something. Help us out here. Quantitative easing, weaken the dollar, send oil prices up. A lot of people complained to the congressman. They said, hey, congressman, oil's $150 a barrel. This can't be good. Every time I go to buy food in the supermarket, the prices are killing me. This is not good. Congress tells Ben Bernanke, hey, listen, quantitative easing, not such a good idea. Try something else. Fed says, okay, well, we have Operation Twist. Let's try that instead. Now, I'm not on the inside. I'm on the outside. So I really don't know. I'm just kind of guessing. But from the outside, it kind of looks like that's the case. In an election year, I think that if I am right, I think that being an election year, I think that could be a really big deal. After all, in the U.S., the economy and the jobs market is the number one topic in all political discussion. Not so much about, anything else, really. It's the economy. So, with that said, it'll be interesting to see. In the car business, we call low interest rate incentives a pull ahead. People bought earlier than otherwise would, but it killed the future sales curve. It's a great example because if you remember, I remember in 2001 and 2002 when that tech bubble first burst and things got really bad. The first industry to react to low interest rates when Alan Greenspan cut interest rates down to 1% were the car companies. If you remember, those were the first companies, the first commercials on TV, zero interest rates now, zero interest rates for 24 months, buy a car now, get back in. And that's one of the reasons why the car companies were able to pull ahead and do so well a long time before other industries. And the same thing happened in 2008. 2008, 2009, the first commercials that I remember, I always watch the commercials with an eye on the economy, trying to see the picture behind the picture. If this company is running this commercial, what does it mean? Commercials are a way of companies communicating their strategies or business strategies to us. And the car companies were one of the first, industries out there to come out with these ads, buy a car now, zero interest rates down, zero payments for 24 months, et cetera, and I think that's one of the, I think Ford the other day reported, better than expected numbers. I think Chrysler as well. General Motors is still in business. That's a miracle in and of itself. I don't know about killing the sales curve later on. You very well could be right, but I do know that it has helped the car companies. I would say this: the next time we have, this could be 10 years from now, but the next time we have a very big recession, interest rates go from 5% down to 0%. I'm going to make a mental note. This is 5-10 years from now, maybe, before we go through this situation again. That to look for the car companies to rebound faster than the others. Real estate to fall again when interest rates rise, or is there a threshold which real estate will rise until a certain interest rate level is reached? It's a good point. The Federal Reserve watches inflation. They watch inflation and they watch core inflation. Core inflation does not include more volatile components of the CPI, including food and energy. So if you take out food and energy, everything else in our economy, that basket of goods and services that represents the U.S. consumer, that goes into inflation. Now, one of the components that I remember an analyst the other day talking about that did contribute to a lot of inflation were rent prices. That because so many people have lost their homes due to foreclosure or bankruptcy or both, that the prices for homes to buy has gone down. The prices of rent have gone up. In fact, I think today in Bloomberg, there's an article about Manhattan rent prices in Manhattan going up, unprecedented levels. I think another 7% in the first quarter. So real estate prices are a component. I'm guessing. They would have to be a component of the consumer price index. And the consumer price index is what the Fed watches to raise or lower interest rates. So, in other words, the Federal Reserve is not going to raise interest rates if the housing market does not recover. If housing stays near the lows or makes new lows, then the Fed does not raise interest rates. Not so much because the Fed is watching the apartment prices in New York or the condo prices in Miami, but if those prices to buy the homes fall, then the CPI is not going to rise enough in order for inflation to tell the Fed to raise interest rates. So I don't know if the Federal Reserve is watching. I'm sure they're watching the individual components. This is how the Federal Reserve comes up with a strategy, Operation Twist, because they watch the housing numbers and the retail sales numbers in this part. I remember hearing a long time ago that Alan Greenspan, former Fed chairman, he watched anywhere from 200 to 300 different economic numbers, if you can believe that. We watch CPI, GDP, unemployment numbers, retail sales, consumer confidence, a few numbers, five, maybe 10 at the most. Greenspan, and that's just in the U.S. Forget about the other 7 currencies. Alan Greenspan, he was watching 200, 300 different economic numbers. So I'm sure that that housing is a component, and I'm guessing that the economy is not going to recover without housing, and the economy will not recover without banks. The Fed has to weigh all of this data and make a very careful decision. Well, if we do this, and there's no such thing as a free lunch. If we do this, it's good for the banks and bad for real estate. If we do that, it's good for real estate, bad for retail sales. So, it's our job as traders to try to anticipate what will be the good and bad parts. The Fed doesn't tell us that. But if we can guess, then, if we can guess correctly, it really puts us on the right side of a really great trade. I learned that Ben is professor of the recession. One of the questions to answer this week. From what I've heard, Ben Bernanke studied the Great Depression, and so we would think that he would be the best, most qualified person to get us out of this. At what point of the time trigger an upward movement in the U.S. dollar? It really depends. The U.S. dollar, we have to answer ourselves the question. By the way, we have the GDP number coming out in a few minutes here. We have to ask ourselves the question. Why does the dollar go up or down? The dollar moves for different reasons in the bond market, which is different reasons in the stock market, different reasons in everything else. The dollar moves very purely in anticipation of higher or lower interest rates, plus or minus quantitative easing, stimulus. If we expect interest rates to be higher and we expect no stimulus, then we would expect the dollar to go up. Think of the dollar like your savings accounts. I have capital all over the world. I'm getting 0 interest rates in my Japanese savings account, and I'm getting 4.25% in my Australia savings account. In the U.S., I'm getting really nothing. But if I think that in the future, I'm going to get more yield, more interest rates in my U.S. savings accounts because I'm watching the economic numbers and they look better than expected, I'm going to move some capital, maybe not out of Australia, but I'm going to move some money out of Japan because I'm not making any money in Japan, so I might as well put it in the U.S., make a little bit more. And the capital moves before the central bank makes a decision because the market's a forward-looking mechanism. It's always trying to, guess the next step. Now, that means higher interest rates and no quantitative easing, specifically quantitative easing, because quantitative easing printed more money, so printed more dollars, and that dilutes the dollar. So I think the dollar goes down if the Fed is anticipated not to raise rates, and if the numbers are so bad that we think the Fed is more likely to give us another round of quantitative easing or stimulus. Leak of the GDP data to others noticing risk on currencies are pressing upwards. Yeah, I mean, let's look at the market here, by the way. The market will move ahead of time. Let's take a look at dollar Swiss, a good barometer of the dollar. The dollar's pushing near its lows. Looks like it's expecting. Here's the chart. Let's do this. They're about to release a number, so the dollar Swiss C is right now at 90.74. 90.74. 10-year bond yield is at 194, 1.94%, and Dow futures really quickly 13,217. Dow futures 13,217. I think I just missed the very, very beginning of the number, but let's take a look here to see. Okay. Okay. Now remember, we were expecting 2.4 or 2.9% estimate for GDP. GDP, 2.2% rate in first quarter, consensus 2.6%. Wow, is that right? That is a disappointment. Now remember my theory. Let's see if we're right here. Let's go to the FX Street calendar just to make sure that I'm not missing anything. Yeah, the estimate was 2.5%. The actual number is 2.2%. That's much worse than expected. The previous quarter, by the way, was 3.0%. So that really is worse than expected. Now, initially, I guessed. Was my guess wrong? Well, I guessed, that if the number was disappointing, that would lead, and I might not be wrong. I think that it's a little bit early to judge the market in the first few seconds. But my guess was this. If the number was a disappointment, which it is, number one, it means the Federal Reserve is not going to raise interest rates until way down the road, at least 2014, the end of 2014. They're further away from raising interest rates. They're closer to stimulus. Now, if the stimulus is QE3, this, I guess, is the real difference. Because if the stimulus is quantitative easing, that would dilute the dollar. If the stimulus is Operation Twist, maybe it would dilute the dollar, maybe not as much. But either way, I think stimulus overall will dilute the dollar. So my guess is, if the dollar was worse than expected, if the number was worse than expected, I'm guessing that would be bad dollar. See, the dollar Swiss is going down. And it would ultimately be good for stocks. Now, stocks, it's a little bit difficult to guess what's going to happen, because the stock market moves in anticipation of corporate earnings. And, on one side you could say, well, more stimulus is going to be good for the stock market. The other side of the coin is say, hey, well, if the economy is so bad, Starbucks is going to sell less coffee, and General Motors is going to sell less cars. So the stock market is a really tough, thing to guess. But I'm guessing that this is going to be bad for the dollar, which ultimately we see the dollar is going down. Here's the dollar Swissy. By the way, let's look at the daily charts. We're pressing the dollar Swissy on a major uptrending support level, 90.50 is that support level, by the way. And if the stock market, the Dow futures immediately reacted to the downside, I think that stocks go up if the stock market starts to think that we're going to get more stimulus. And remember, by the way, before this number was released, the dollar Swissy was 90.74. The dollar Swissy is now 90.68. It's only 6 or 7 pips. It's the immediate reaction, though. 10-year bond yield was 1.94%, now 1.93%. Dow futures were 13,217, now 13,222, but it wasn't actually 217. It was actually 230, 240. Because I wrote down the number just after the number was released. So the stock market is so far indicating down. So are bond yields, and the dollar is also going down, which is kind of curious. Stocks are going down, bonds are going up. Gold, I would expect to go up as well, because gold acts as a hedge towards a weak dollar. The dollar goes down, traders are going to look for another instrument to hedge their dollar, their dollar exposure. That would be gold. Now, what are we missing here? Oh, the other side of the trade. Now we think of the other side of the trade. Let's say we take this as a sign. Okay? And, I used to work with a friend of mine, and we're still friends, and we used to work together though. He had this great expression. He used to say that the tops and bottoms of markets are created by fundamental events, and a technical analysis explains everything that happens in between. When I started out watching markets, I would think that, people told me, well, the market moved, the economic numbers released, and then that's it. You've missed it. And I guess that's from my training as a day trader. That once the company comes out with corporate earnings, the stock is up $10 or down $10, and it's better for us to use a buy low, sell high approach. And I used that type of philosophy for years and years and years, thinking that I'm not going to buy the stock after good news. I'm not going to sell short the market after bad news, because, once the news is released, everybody knows about it. And this is the difference. As a stock trader, it is true. But I think it also, and I agree with you on that point, but I think it also has to do with the time frame. On the dollar Swissy, the news is out now. The dollar Swissy originally went down. And the dollar Swissy, if we sold short in anticipation, this is a 5-minute chart, in anticipation of the bad news, this would be the time to cover our trade. Buying a rumor, selling the news, or in this case, sell on the rumor, buying the news. That's a day trade. And now the day trade might be to go back up. But recently I've had a little bit of a change of hearts, meaning that I also think that maybe you take this bad news as a sign that there's more to come. I mean, after all, think of the really bad stories and the bad, I use negative because they're easy examples, and we just had so many of them. Think of the economic recession. AIG first got in trouble. Lehman Brothers said, you know what? We looked at our balance sheets, and they don't look so good. We might not make our earnings this month, this quarter. And then the Lehman Brothers eventually went out of business. Enron at $40 a share said, you know what, I think there's some improprieties, or somebody said, I don't know if Enron is telling us everything that they need to tell us. Think of, there's a million examples. Think of the housing data. The housing market did not just go up and up and up in 2007, and on Monday it looked fantastic, and on Tuesday it looked horrible. The housing market data got worse and worse and worse over time. Now, in the middle of the highs and the lows, I think the trend is your friend. But I think that we take this number now, for a day trade, the dollar Swiss, you might look to buy it. I mean, after all, we have a long-term uptrend support level. And as long as we don't break below 90.50 or yesterday's lows of 90.57, I think the dollar Swiss could be a day trade back to the upside, sure. But today's GDP number is telling me that the economy is not so hot. The Federal Reserve just met 48 hours ago. And 48 hours ago, they told us, that the estimates are 2.4 to 2.9% GDP. And lo and behold, Friday morning, the numbers are really they're pretty bad. They're worse than expected. Economies take a long time to turn, especially FX, foreign exchange markets. Stocks, corporate earnings could change in one quarter. An economy, the U.S. economy, this is a very big, slow-moving steamship. It takes a lot for it to move. There's a great example. Let's see if I can remember the dates right. Bank of Canada met, I think it was last week. It was either last week or the week before. I can't remember. I think maybe it was 2 weeks ago. The Bank of Canada met on a Tuesday. They said, the economy really looks great, and the markets, let me look at the chart here. And we expect that we're going to raise rates sooner than we once thought. Things are awesome for us. That's what the Bank of Canada said. And that was on a Tuesday. And lo and behold, the following Friday, it must have been 2 weeks ago. I drew lines here, and I still have these lines. Okay, so on April 17th, the Bank of Canada met, and they said, things are great. This is the CAD yen daily chart, by the way. This is on April 17th. CAD yen went up. There was a big reaction from that number. That was Bank of Canada interest rate decision. It said things look great, and we think things will be better, and we think we're going to raise interest rates sooner than expected. Well, on April 20th, the Bank of Canada released their CPI numbers. The unemployment numbers were good. I think it was CPI. The CPI number was much worse than expected. And then all of a sudden, the anticipation that Bank of Canada was going to raise rates, that went out the window. And all of a sudden, the CAD yen went from hitting highs of 82.49 down to lows of 81.20. Now, since then, we've gone up a little bit, but I kind of think that we're still going to go to the downside. Point being is that don't expect so much that, for a day trader, the bad news is out. Now everybody knows about it. Now we're going to see a bounce back up in the dollar. That could be true. But I'm taking this as a sign, a long-term sign. Look, the GDP number, it's showing us what the economy is doing, and it's telling us a bad story. And that I'm not going to expect long-term that the dollar Swiss is going to go up. There are those really key inflection points that things look so bad that you have to buy, like the Dow Jones Industrial Average 6,000 in March of 2009, or when things are so unbelievably optimistic, like, Dow 14,000 going back to 2007. But that's why we have the VIX, the volatility index. When the VIX hits 15 or above 40, that's when it tells us the market's hitting very, very extreme levels. It's not the case now. The VIX is at 16 now. We've already touched that 15 level. So I would not necessarily expect that, that the dollar Swiss is a good buy. I would rather sell the dollar, not now, and wait for a rally, but I want to sell the dollar Swissy. I want to sell the dollar because I don't think that the Fed is going to raise interest rates anytime soon, and I definitely think we are much closer to some sort of stimulus. I mean, if you read the statement from Ben Bernanke just 2 days ago, he said other measures are on the table. UK economy is slowing too. GDP numbers in UK were not good either. GDP numbers in UK were just the other day, and that was the first. I remember talking about the UK economy, and all the numbers over the past month look pretty good. The GDP numbers are the first bad numbers I've seen in a while in the UK. Yeah, I mean, when the stock market opens, the stock market, how can I say this in a nice way? The stock market, well, every market has its own personality, but the stock market is made up of individuals that trade stocks. And individuals that trade stocks, they watch, nothing wrong with it, I guess. They watch CNBC, they watch Jim Cramer. They tend to get very excited very, very easily. And they tend to react very, very emotionally to news. Not to say we should not react to the GDP number, but we're Forex traders. You know, we watch economies. We watch the bond markets and interest rate moves, and, you know, we look beyond the Jim Cramers. It's important that Starbucks is selling a lot of coffee, but you know what? It's more important to me to look at the fundamentals behind that. And that the stock market, I think, I'm sure, will have a reaction. The Dow futures now 13,213, and for all intents and purposes, I'm expecting a negative opening to the stock market. After all, the 10-year bond yields at 1.92%, 192, 193. Before the number was at 194. The bond yields are down about 0.5% for the day. So it's indicating a slightly negative opening. We've had some bad news out of Spain overnight. Their credit rating was cut by S&P. We've had some bickering from this individual that looks like he's a front runner in the French elections. And he was telling Angela Merkel, well, you know, Germany is not the only country out there. You know, don't forget about us. So, we've had there's some political reasons. We also have Swiss National Bank, Jordan, said policymakers are ready to take further measures if needed to weaken the franc. So the dollar, maybe that's why the dollar Swiss is not going down so much, because everyone is worried about the Swiss National Bank intervention. Interesting. Very, very interesting. Dollar Swiss is hardly going down. I should have been watching the euro dollar, the Aussie dollar. Take a look at these currencies. Very interesting indeed. I completely forgot about the Swiss National Bank. Remember, they intervened because the dollar Swiss and the euro Swiss went down so much. Maybe that's one of the reasons. Maybe that tells us that the dollar Swiss is a better buy. I'd rather buy the dollar Swiss than sell short the euro dollar, because the Swiss National Bank has just come out in the past 24 hours stating their intentions to defend that price level. Would the VE opening be a buying opportunity? If you're referring to the stock market, I'm not going to buy. I'm definitely not going to buy in the open. I mean, that's a mistake that I've made in the past. That, you know what, we've done the homework and we've reacted to the number maybe, and we would expect the market will do the same. But when the stock market opens, a lot of traders still have to. Not everybody has done this kind of homework very common like we have. A lot of traders are going to wait for the stock market to open, and they're ready to push the buy and sell buttons. I'm going to step on the sidelines. I'm not going to wait. You know, if the market goes down, I'm not going to try to buy it until after the active session, 10:30, 11 a.m. Eastern. I want to wait for the other economic numbers to be released. But to be perfectly honest with you, I'm not buying the stock market. I'd rather be a seller. If I'm hoping that the stock market rallies, gives us a good price, you know, and then we have a chance to sell at a high price. But I'm not going to buy it all. I think that, you know, this is a little bit on my own personal fundamental opinion. It's been tough. And the stock market does like quantitative easing. So I think that's one of the reasons why stocks have been so strong lately. But I don't want to be a buy. I don't see. Look, I know I'm running out of time here, but I know that quantitative easing is good for stocks. We all know this. The Dow has gone from 6,000 to 13,000 in the past couple of years. mostly because of quantitative easing. But I don't believe GDP at 2.2%. I don't believe that is conducive of stocks going higher. It's a very narrow rally. It's a very narrow economic rally. We know this because Apple Computer is $607 a share. Bank of America is $8 a share. That's not conducive of a broad-based economic rally. Unemployment has been above 8% for the longest period of time since the Great Depression. GDP, the Federal Reserve 2 days ago told us 2.4, 2.9%. We can't even hit those numbers. So quantitative easing, now if you want to take this next step, you look for the unintended consequences. You know, the Federal Reserve is giving us a lot of stimulus that's helping the stock market up. But again, there's no such thing as a free lunch. And that the stimulus that is supporting the market now, we're going to have to pay for in another way. I don't know what it's going to be. It could be a bond market bubble. It could be a commodity market bubble. It could be something else. But there's no such thing as a free lunch. And yeah, buying off the open, they say that, well, there's an expression, they say that the amateurs open the market and professionals close the market. That's an old day traders expression. With that said, I'm out of time. If you have any questions, you can contact me directly, www.forexlounge.com. I want to thank you all very much for joining us. Very special thanks to FX Street. Please see the calendar because we have a lot more ahead of us. Again, we thank you for joining us. We wish you a great day, all profitable trades. And we look forward to seeing you back soon. Back in sound.